Welcome to the Possible Promise Podcast. Every Monday, Wednesday, and Friday, we go live at 12 p.m. Eastern to break down the complexities of finance and point the way to financial success. Today is June 26th, 2020, and I am your host, Brandon Oliveris.
And I'm his favorite wife, Christine.
This is episode 7, The Power of Option Spreads. Welcome to the podcast, and just as a note, I don't get a choice of my favorite wife.
Well, you could.
No,
if you wanted to. No,
that's okay. I'll stick with what I have.
It was for shock value.
Oh, I see. Okay. So, today's Friday. I don't know how good that is. This has been a rough week.
Pretty sure Brandon's hair is going great.
Probably. I mean, actually, today's not that bad for me. I haven't looked in a while, but I was up for the day, but oh my gosh, we're down. So, the market's been a little rough. I mentioned on Wednesday that Wednesday was a bad day. What is it with days we broadcast? The market goes down. I don't know.
Maybe we shouldn't broadcast.
No, we still definitely should. I'll just buy more puts.
Okay. Just buy them on podcast days.
That's right, yep. So, let's get into it. Let's see how we're doing. I think we're off of our lows. We were down about 2% earlier. Alright, so S&P is, let's see, down about 51 handles on the S&P. About 1.66%, to be exact. NASDAQ, I'm sorry, I always get that confused. No, the Dow, DJX, the Dow is down over 500 points, almost to 600, to a little over 2%, so that's kind of leading the loss. NASDAQ is, for once, below 10,000, down 132 points, or 1.3%, and the VIX, my favorite VIX, is up 7% today. When it's up 7%, you know it's a bad day. So that's kind of what's going on. Let me see what's going on with the Russell, because my script won't tell me the Russell. Let's see. Thank God for Google. Yeah, the Russell's down about almost 2%, 1.8% right now. So it's a rough day because there's a lot of stuff going on. Texas just announced that it is basically pausing the opening. It's closing bars again. It's restricting restaurants to, I think, 50% capacity, which apparently they were higher than that. I don't know why.
Well, that's stupid.
And Florida's thinking about doing the same. And
well, it's because they were stupid and opened all the beaches or something.
Yeah,
Didn't they? Or
I don't know, honestly. I don't know. I just know cases have been rising in Florida and in Texas and in Arizona.
I might know the reason for Florida.
Yeah. And so, besides the beaches?
Yeah, well, I don't know. Well, I know the beaches are open, but there's this Christian group.
With churches?
Yes. But no, there are people that are on the beaches doing, like, services and stuff.
Oh, gosh.
There's a specific group that's been doing it. I just saw it on YouTube the other day.
Oh, okay, yeah. Yeah,
and so they're packed.
Oh, my gosh. I don't know why people don't take it seriously. In fact, I just saw a report yesterday, I don't know if you saw it on Twitter, I posted it, that the CDC is now saying that actual coronavirus cases could be as high as 10 times more than the confirmed cases. So we could have up to 25 million cases here in the U.S. Apparently it's, I guess, 2.5 million right now. So that's pretty crazy if that's true. Which, I mean, in a sense, I mean, we want, until we get a vaccine, like the next best thing is herd immunity.
Yeah.
So, I mean, we kind of want cases, but at the same time, we don't want cases.
Well, the balance is getting it only to the healthy people having it and not spreading it to those that can't.
Exactly.
Like, that's what's hard.
Yeah, that is hard. That's because a lot of people, especially older people and even kids sometimes, but even now I heard it's people in their 40s and 50s are starting to get it more, so it's spreading, and it's just hard. But I think for healthy people, but they can take precautions and be out, but still, I mean, don't be packed. I mean, that's just stupid. I don't know why you would be really close to other people right now with everything going on. I don't know.
Like, this group was baptizing people.
Right, yeah.
That's
crazy.
Yeah.
So
I can't tell if they were wearing masks, but it didn't sound like it.
If they're packed, I doubt it. Those types, no offense, those types who aren't taking it seriously, they're not going to...
I could report them.
They're not going to be close together and then wearing masks. Like,
yeah. I mean, I wish there was a way to report this. I know exactly the name of it.
Yeah.
But...
So, but yeah, it's just nuts. So the market's starting to take that more seriously. Especially now, the market, it can be a little cold. The market doesn't care if people are getting the coronavirus, if it's spreading. It doesn't care as long as the economy is not affected. I mean, let's just be honest. The market's very cold in that way.
Well,
right?
that's the point.
Investors care about money, which, I mean, I'm an investor. I care about money.
No, really?
Yeah. So the market cares about, it doesn't care about necessarily it spreading, but it cares about that, the economy may get closed again. Although, the government's saying we're not going to lock down again. We're not going to shut it down like we did. But some states are having to do that. Texas and Florida, like I mentioned, and we just have to see what happens. So yeah, that's what's going on with that. So it's kind of an ugly day. Combined with Wednesday, I mean, we definitely are down for the week. So yeah, it's been pretty nuts. I'm curious if you remember, we talked about RSI on Wednesday, and so I'm kind of curious where we are for the day here. Let's see. Yeah, we're down at 47 RSI. So I like to keep an eye on that because it kind of tells me like how bearish people are. The lower below 50 it gets, the more bearish I think people are. So I'm just really curious to see where it goes from here. It's anyone's guess. I mean, I really have no idea. I think it could go any way from this, from this point. Down is probably more likely, but I mean, look at what was going on a couple weeks ago where it's just going up. So
you just never know. It's bipolar, I think.
Probably. All right, so with that, we will get into the week in review. It's actually my favorite of the sounds.
That's a nice Friday sound.
Why?
I don't know, because it's like exciting.
I guess that's my favorite, probably. Well, I also really like the Mondays one that you were dancing to earlier this week.
Hey, wait! I don't think anyone knew, did they? That I was.
Yes, they did. I said, "Are you dancing?"
Oh, that's right.
Yeah, they did. And if they didn't, now I told them. So.
Oh well.
Yeah, she was dancing.
Sort of in my seat.
You were definitely dancing.
Maybe. Yeah, it was.
So, anyway, so the week in review, this is where I just want to share with them. Well, we kind of already did a little bit what the market's been doing, but also...
Yeah, you jumped ahead there a little.
Well, but also my personal portfolio, what's been going on for me, how things have been going.
Like Wednesday?
Wednesday was a problem.
You lost over $400.
I did lose $400 on Wednesday.
Or $400.
$425, I think.
Sorry to burst your bubble, but
That's
it's fun to pick on.
It happened. It was, like I said, a gambit.
And just so you know, he gets really upset. He can play it off on the podcast, but he was beating himself up the whole day.
It was just so... It seemed like such a good chance. Like, I really thought, if things just stayed where they were, stayed steady, even if they dropped a bit. I mean, who could have seen the market dropping like it did on Wednesday. That was just nuts. And, I mean, it was like, it fell off a cliff. I mean, I watched as it went from an opening of about 31.14 for the S&P, and then it went down to, like I said, to like 30.95, and then next time I looked, it was at 30.50. Next time I looked, it was at 30.30. I'm like, where's the bottom? I mean, that's just, it's crazy.
Where was the bottom to that? Do you know?
I think I'll look it up real quick. I think it was around 30.30.
Oh, it was?
Let me see, though. Yahoo always has that. So I'll look at that. But, yeah, I mean, it was just, like, it fell off a cliff, and it was just going, like, at 30.50, I was like, oh, that's probably what the bottom's going to be. And then it kept going.
Oh, my God.
So that was the 24th. It was exactly what I said, 3,032.
Oh, my God.
And the high for the day was 3,115. So that shows you what kind of, I mean, that's like an almost 80-point gap, over 2%, like what's 2.5%, I think?
In a day.
In a day, yeah, that's huge. So no one could have seen that coming. I mean, that was nuts. I got wiped out with that. But it's okay. I mean, it happens.
It does. It's just fun to pick on you.
But other than that, it's been a really good week.
Yeah, you were up yesterday, right?
I was up yesterday. I'm up today so far.
Why do you say it like that?
Well, because I've had days where I was up for most of the day, and then right at the end of the day something happens and I'm down. And I've had days where I'm down most of the day. I literally had days where I'm down like 2-3%.
And then you make a lot.
And then things turn around and I'm up 2 or 3%. You just don't know. It just depends. So it's not over till it's over, right? But I had a lot of... Okay, so apparently I forgot putting on a position on Nike yesterday. I have a script. Go ahead.
Of course you do.
Okay.
I have to always say that.
Yeah, that's...
I'm getting so immune to it that I forget to say it.
I have a script that finds the best and most profitable credit strategies for options in the current market, like for today, and reports back to me, and I can either say yes, trade it, or no, don't trade it.
And it'll actually do it for you.
If I say yes, trade it, then it actually goes and trades it, and then it actually goes and opens the closing good till canceled trade at 50% profit. It's a really useful script.
You're going to make everyone jealous and want that program.
I know. Someone told me the other day I should sell it, but it's a text-based terminal program. I'd have to kind of, I don't know, spiff it up, I feel like.
I don't think you would.
I'm lazy. I have all sorts. I mean, you would not believe how many scripts I have. I have scripts to calculate my total delta in my portfolio. I have scripts to place trades. I have scripts to get technical analysis, information. Like anything you could imagine, I have scripts for, pretty much. Which is the benefit of being a programmer.
Yeah.
But, so I put a short position for Nike yesterday. It was a call credit spread, which we'll talk about spreads today. But a short call. I sold a call option. Just if you remember back to last Friday's episode on selling options. But I put on a short position on Nike, and then the last night, I think it was, they had horrible earnings. I didn't even realize. I didn't even look that it was earnings. I should have, but but had horrible earnings, and it slid down. It was down let me see what percent today. Let me see. It was down a lot today, and I got an email this morning. Order filled for Nike, and I was like, oh, well, that's cool. I didn't know I did that. It's down almost 6% today. So that shows you how bad it did.
So that didn't work for you?
No, it did. I went short, which means
right.
I benefit if it goes down. And so it worked out great. I made, I don't remember how much I made. A good bit. I made a 50% profit before it closed. So that was perfect. That was great. And then I was lucky because I went short on financials. XLF is the financials ETF. And, sorry. the Fed was doing some kind of stress test with the banks yesterday.
It sounds like a heart problem. Stress test?
And I guess it was pretty good overall, but there were some issues. And so today financials are down. Let me see how much that's down today. It hasn't closed out yet, but let's see. It's down almost 4%. So I was short XLF yesterday. It's down today, so I'm making a profit. So that's working out. I had an SPY, which is the S&P ETF, short position on a call spread that one of them closed out today. I have another one that's on that hasn't closed out yet, but I'm sure it will soon. I had a Russell close out that was a short. All my short positions are closing out. I had a bonds TLT closed out. What else did I even do? Yeah, I had a lot of stuff.
Don't look at me.
I don't know. You should know everything. But it was a really good week for things closing out. But I'm having to find new short positions because a lot of them closed out this week because of the drop Wednesday and today. So that's been pretty cool. But yeah, so it's been going well with all that. I rolled out. On the losing side, I closed out. I had one on EWG, which is the Germany index, I think. And that one went against me a few weeks ago, and I've been trying to get it back into line since, and it just hasn't been getting there. Even with the drops, it still wasn't out of the money. It still wasn't in the range I needed it to be. And so yesterday I just said, I'm going to just close it out.
I didn't know you did Germany one.
Yeah, I did that a while ago. And it just wasn't working. I could have rolled it out probably, but it just wasn't working, and I wasn't that confident it was going to work. And then I rolled out, I have what's called an iron condor, which we'll talk about later. Basically a neutral position on Merck, MRK. And, or no, it's not neutral. It's a put spread. So I have a bullish position on Merck. And I just rolled that out to August yesterday. So that has another month to work.
Oh, cool.
It's not totally against me, but it's not been going great. So
I guess we'll have to see what happens.
Yeah, we'll just have to see what happens there. So that's what's been going on with my portfolio. Besides, like I said, my little gaffe on Wednesday, things are going pretty well overall.
That's okay. It wasn't really your fault either, though. It just happened.
I know it happened. So that's pretty cool. So, like I said, the market is definitely down for the week. Let's see how much we're down this week. I'm curious. So today we're hovering around. What are we at now?
Hovering.
I meant to say that.
Or hoving.
3,030, and let's see. Last Friday we were at 3,097. That said, right?
Oh yeah.
So that's like what? We're down for the week. A good over 2%. So yeah, that's what's going on this week. The thing I love about options is that even though it's down, the market's down today. It was down Wednesday. Like you can still make a profit.
Yeah.
Right. Most people. I saw a post yesterday or this morning. I don't remember. Someone said they were down like $5,000 this week.
Oh man!
Because of the market, and I think someone else said they were down like 50%.
Oh my god!
And I literally responded and I said, if you're down 50% in 1 week because of the market, you're in some bad positions. Just start over. That's.
Did they actually listen to you?
No, I doubt it. I don't know. They didn't respond, but that's what I said. That's. Shouldn't happen. I mean, if the market's only down 2% and you're down 50%, that says something about your positions, right?
Yeah.
So, that's not good. All right, so that is our week in review. We're doing great time-wise.
Yeah, for one.
Which is always famous last words. So
you shouldn't say it out loud.
All right, well, you will anyway. It's already done. So let's get into our segment. The power of option spreads. So last week we were talking about options all week. On Monday, episode 3.
What?
Yeah, episode 3. Not this Monday, last Monday.
Okay, yeah.
We talked about buying options and, the 3 things that need to be in your favor. And then...
No, it would be episode 4.
No, because this is episode 7. We've had 5, 6, and 7 this week. I'm talking about Monday. And then Friday was episode 4. We talked about selling options.
Oh, you're right. I'm sorry. I was counting Wednesday.
Yeah, I know. This is our first Wednesday.
I know.
And so... I usually don't. So, last Friday we talked about selling options. The house always wins. That was that episode title. And why selling options is generally better than buying options, right? But most people don't just buy a single option or sell a single option, okay? Because it can be rather capital inefficient, which just means, and also it's greater risk. So it just means that it uses a lot of cash to just buy or sell one option. And options can be combined into all sorts of different strategies. I mean, there are tons of different strategies. Ones that I haven't even done yet. Like there's a strategy called the Christmas tree strategy.
Oh my god, I love it. And
I have not done that one. I don't think it's, super popular. I mean, it could be, and I just don't know, but I haven't done it.
So just because you haven't done it, no, I'm kidding.
Well, I'm also around a lot of people doing options that I've never heard someone mention. Yeah, I'm going to do the Christmas tree strategy.
Try it just for the name.
It's complex. It has like 6 different options included, I think. I don't remember. I read about it on Investopedia once, or a couple times, and I was like, that sounds really complicated.
Oh, you could do it. Anyone could, it's you.
Anyway, so you can combine options in just so many different ways to get different results.
How many do you usually have at once?
Either 2 or 4.
Not 3?
Not 3.
Okay.
No, generally not 3. You can. There's something called a ratio spread where you can do like so many shorts and so many longs, or more longs than shorts, or more shorts than longs. It just you can have like a 2 to 1 or whatever.
Gotcha.
So you can do that.
So you usually do 2 or 4.
I usually do 2 or 4.
Okay.
Either credit spreads or iron condors are generally what I do. So, which I'll talk about. Christine knows what an iron condor is because
I've enough.
Told her, all the time. Okay, yeah, probably.
I couldn't replicate the.
Christine, what is an iron condor? No, just kidding.
No, don't even go. It's a bird.
Yeah, they are birds. I don't think they're made of iron, though.
I don't know.
Anyway, so you can combine options in a whole bunch of different ways to get different results, whether you think the stock's going to go up, down, sideways, whatever you think. And I will cover a few of them today. But let's talk about why you generally wouldn't just buy or sell one single option. Not to say you can't, but why you wouldn't. So let's say on the buying side, okay, let's say you buy an option, whether it's a call or a put, let's just say a call for simplicity's sake, of a stock, and because you think it's going to go up, right?
Yeah. And
so remember, when you're buying options, you need to have 3 things in your favor: direction, distance, duration. I wish I would have had that the first time we did this episode last Monday. I didn't have the duration thing because I love the 3Ds. That's perfect.
I like it too.
But anyway, so you need to have those 3 things in your favor.
Yeah.
Now, when you're buying an option, especially if it's in the money, which just means for a call option that the strike price is under the stock's current price. In the money means that if you were to close out the option today, if it were to expire today, it would still be worth something.
Yeah.
And out of the money means if it were to expire today, it would be worthless.
Yeah.
It has no value. So
that makes sense.
So if you were to buy an in-the-money call option, it's often rather expensive. Okay? Mm-hmm. Like right now, I'll give an example. Right now, SPY, which is the S&P ETF, is at 301.60.
Oh, wow.
Right. And so if I were to, let's just say I want to buy a 300 strike SPY call for July 17th, right? So I can, let's see what that would be. Sorry, you have to listen to the nonsense. Care. So, that's not right. I need a few more zeros in there. There we go. Anyway, if you were to buy the 300 strike, which is in the money call option for July 17th, let's make sure I got it right. Yep, July 17th, 300 call. Right now that's going for $9.63, which doesn't sound bad, but...
They add up though, right?
Well, kind of. The caveat is, what's the thing about, do you remember about option prices? They're not as cheap as they look because they cover 100 shares.
Oh, yeah, that's right, yeah.
So that call option actually costs $963.
Yeah, that would make sense. Yeah.
Which you may not want to put down on a single call option. And the thing is that with a call option costing $963 or $9.63 per share... what's the break even? Okay, let's test Christine on this one. Oh God, no! Okay, please. What's the break even? Oops, that's not the sound I wanted. Okay, that's if you get it right. There it is. What's the break even? That's our timer. What's the break even for a 300 strike with a $9.63 contract?
$355?
No, $9.63. What's the break-even price?
I don't know. 5. Oh.
The break-even is the strike price, 300 plus the premium, $9.63 for $309.63.
Oh, okay.
Remember, we got this so well, like last week. You were on top of this. I'm so sad.
It goes in my head and out the other.
Uh-huh. I don't know. You were getting it last week.
I don't know.
So, the break-even for a $300 with the strike SPY call option for July 17th, which is, if it costs $9.63,
would be $309.
Is $309.63.
I guess I was just overcomplicated.
You're saying by July 17th, this needs to be at least $309.63 for me to make a profit. Which you may not be that bullish. With it currently at 301, you're looking at a 2% gain in the next month. Basically, right? Just
right.
In my head math. I mean, you're looking at basically a 2% or 2.5, almost 3% gain. That's an $8 difference. So you may not be that bullish. So what do you do? So, that's... If you were to create what's called a call debit spread, it's still where you're buying the option. It's a buying strategy, what's called a debit strategy, because you're paying money for it.
Like a debit card.
Yes. But if you were to combine two options, which I'll explain in a second, you can lower the price and you can lower the break even.
Oh.
So let's say, you're going to buy the 300 strike for July 17th at $9.63, right?
Uh-huh.
But what if at the same time we sell the 310 strike for July 17th? Now, if you sell, remember when you sell, you get the premium. You collect premium in return. So let's see, all these zeros. The 310 call for SPY right now is going for $4.15.
Okay.
Right? So, that's the 310 strike for July 17th. So, if you bought the 300 strike for $9.63 and sold the 310 strike and received for a credit of $4.15...
It'd be 305.
You take the net, so $9.63 minus $4.15. it only costs $5.48.
That's what I said, $5.48.
Yeah.
Or, well, I didn't know what the cents were.
Right, yeah. So now, because you can kind of add those two together, or we'll subtract them, you add in the debit and subtract the credit. Subtracted it. Yeah, you did a good job. So the break even then is $305.48.
Yeah.
Right?
See, now I'm on top of things. You didn't even test me.
I know. I'll give you the... Okay.
After making a fool out of myself the first time.
So now you don't have to be quite as bullish. It only has to move about, $4, which is reasonable in a month or a few weeks. About, 1.5% or so. And, your outlay of cash is a lot smaller. Instead of having to pay $9.63, you only have to pay $5.48 or, $548 for the whole strategy. That's what's called a call credit, or called debit spread. Also called a bullish or bull call spread.
Bull call spread.
Because you're bullish, right?
Yeah.
So that's the upside. So you get lower outlay of cash.
Outlay? Yeah,
like the cash you have to put out to buy it.
I've never heard of that word before.
Anyway. Lower, cash requirement. Mm-hmm. And a lower break even. Okay, so in the first case, let's say SPY reaches, $310 by July 17th. In the first case, with a break even of $309.63, you're only going to make a 37-cent profit, right? Which is still $37 because you have to multiply by 100. But, for that kind of 3% move, you think, I should get more than that,
Right.
But in the second case, with a break even of $305.48, and it reaches $310, subtract the two, you get a $4.52 profit, or $452, right? Which is almost 100% profit.
Wait, how did you do that?
The break even's $305.48,
and
let's say SPY reaches $310, so you just take $310 minus $305.48, and that's your profit.
Oh, okay.
Yeah,
sorry.
That's all right. So it's nice in that way because you have you can make a bit more profit if it reaches the same number, and again, less or lower cash requirement and lower break even. So it's easier to reach that number, which is awesome. Now, if you're even less bullish, you could even sell the 305 instead of selling the 310, and then the break even's even lower. So let's say, just for one last example, instead of a 310 you're going to sell a 305. Let me make sure I'm right here. All right, so a 305 credit, a call credit, is $6.59, right? So that makes, what's it, 963 minus, oops. No, okay, look, numbers.
Do it.
It's just not cooperating. All right, 963 minus 659 equals 304. So that, if you do a 300 and 305 spread...
Wait, where'd you get the 6 something?
That was the cost of the 305. So, see? It costs, or the credit is $6.59 for the 305 call.
$6.59, I don't know where that number is.
That's the cost, or the price of the 305 strike call for July 17th is $6.59.
Okay, I'm sorry.
That's all right.
I'm like, what kind of crazy math is this?
No,
but
yeah,
it's
that's
not.
No.
It's a data.
So the 310 was $4 and something.
Oh yeah, okay, all right.
The 305 is $6.59, right?
You're gonna make my brain.
I'm sorry, I know. So that makes your break even 300 and 304.
It's at 3.04.
3.04 is the net cost.
Okay.
When you add that to 300, it's 303.04.
Okay.
And so now you only have to go up, not even like 0.5% to profit by July 17th. And so it's much more likely to get there.
Gotcha.
Right?
Yeah, that makes sense.
So So that's cool. Now, those are a lot of upsides. There's always a downside. What's the downside? The downside is that the short call option, the short option means whichever option you sell to offset the option you buy. So either the 310 or the 305, that caps your profit. So let's say you sold the 310 option against the 300 option, right? That means anything above 310, you don't get that profit because it's
below 300, right?
Well, below 300 you're going to lose.
Oh, well, yeah.
But anything above, so let's say SPY reaches 311 or 312 or 313, anything above that 310 is capped. That's your maximum profit. So your maximum profit for the 300 to 310 call spread.
It's 310.
Well, that's the most it can reach. Mm-hmm. But with the break even of 305.48, your maximum profit's $452. Okay, so you take the a $10 spread minus the premium of $5.48, so your max profit is $452.
Yeah.
With the $5 wide spread, it costs $304, but it's only $5 wide, so your max profit is $1.96 or $196. Mm-hmm. So it caps your max profit. So if you think, it's definitely going to go over 305 by July 17th, then don't sell the 305 option.
Right.
Right? So it's a balance, as everything with options, between checking time. Oh, we're good. It's a balance between, how high do I think it's going to go versus how much profit do I want to make, and how likely do I want to be of getting there. So, just to summarize that, okay, I know that was a lot. But Christine, I almost say even Christine. I'm sorry, that sounds condescending.
Well, it's okay because this isn't what I do.
Yeah, but Christine's keeping up. So,
pretty well.
To summarize, just buying the $300 SPY call for July 17th, you have to reach, it costs $963. So it has to reach at least $309.63 by July 17th for you to make a profit. Mm-hmm. Right? Anything under that, you're going to lose.
Yeah.
But if you sell the 310 against it, then you only have to get up to 305.48 because it costs $5.48. But you're capped. Anything above 310, you lose.
Right.
Right. Or you don't lose, but you don't get that profit.
Right.
Or if you sell the 305, then anything above 305, you don't get.
Yeah.
So let's take three scenarios. Let's say SPY on July 17th reaches, $310. In the first scenario, you have to subtract 310 minus the break even of 309.63. You make $37. Woohoo. Okay? In the second scenario, you reach 310, which is your max, your cap anyway, minus the break even of 305.48. You make $452, which is a lot better.
Yeah.
In the third scenario, 310 is above your maximum of 305, so you still only make $196. Right? Because you're selling the 305 call, so 310, doesn't matter if it's 310 or 500.
Yeah.
Anything over 305 is lost to you.
Yeah.
So that's the, pros and cons of call debit spreads. It's the same thing with puts. I won't go through it, but you can try it yourself. With puts, you buy the high strike and sell the low strike. So you could, let's say, buy a 300 put and sell a 290 put. And
so it's just backwards.
It's just backwards, right, exactly. So that's with buying, options. Usually you want to do a spread, a debit spread, because it lowers your break even, it lowers the cash requirement, and, it's more likely to get profit, even though it caps your profit. Okay, so that's for debit spreads.
Do you ever do credit spreads or no?
I do almost exclusively credit spreads.
Oh, why not? But you just said It's because of debit spreads.
No, I'm saying if you're going to do a long option, if you're going to buy an option, do a debit spread.
Okay, but you sell them.
I sell options, so we're going to talk about credit right now.
Okay.
So I'm just saying, if you're going to buy a long option, unless you're really, 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 really bullish, it's almost always better to sell an offsetting option to make it a debit spread. Because again, the benefits, you're lowering the break even, you're lowering the cash requirement, and it's going to be more likely you profit. The only downside is you cap your max profit, which is, why would you complain about that? It's still profit.
Right.
Right? So that's the only downside. So I'm just saying, if you're going to buy an option, make it a spread.
I didn't know, because you said credit spread earlier, so I was confused.
Yeah, we're going to talk about credit spreads.
Oh, but you didn't mention it just because you mentioned it. Okay.
All right,
I didn't know if you misspoke.
No, I don't think so. I mean, I could have, but... So let's take selling options. Now, the thing about selling options, and this makes it even more important. Let's say, SPY is a 301, whatever, 301, 302, and I want to sell a put against it, which means if I sell a put, remember, if I buy a put, I think it'll go down. If I sell a put, I don't think it'll go down below a certain price. So let's say SPY, let's just check the updated, whatever. SPY is now at 301.33. It's going down.
I thought it did.
So, let's say, it's a 301.33. But I want to sell a put. Let's say I don't think it'll go under like 295, right? 300 is too close. That's not, if it goes under 300, that's too close because it might, right? But let's say I want to sell a put at 295, which just means I receive a credit, but it can't go below that price before the expiration or I'll lose, right? So let's take a credit. I'm going to tell you exactly what it is. If I have to do a call, not a put, which is a P, not a C. All right. So the 295 put, which is out of the money, currently gives a credit of $6.53. So let's just say right now I sold a 295 put on SPY, I would receive a credit of $653, which is awesome, right? Right, Christine?
Yeah. No, I wasn't sure if it was... Sorry, I didn't know if it was rhetorical.
Isn't that good?
Nope.
Money's good. Cool. Now, the thing is, what if SPY has a horrible crash again? Mm-hmm. Right? The thing with credit spreads is that you have a nearly limitless loss potential, max loss. So, if I get a 653 credit for a 295 put, that's fine, and that's great. So anything above 295, I keep the whole thing, even down to if you subtract 295 and 653,
it's
$288.47. Huh? $288.47. $295 minus $6.53.
Oh, $6. Okay,
yeah.
I thought.
So anything, my break even for a credit spread, like that, it would be like 288.47 or 47.
Yeah, okay.
So anything down to that level, I'm going to make something, right? But what if by July 17th, SPY goes down to 275?
Ooh.
That's bad, right? Well, that means I'm losing $20. There's 295 minus 275, right?
Yeah.
So what that means is with a put, remember you get assigned, I have to buy the 295 and I'd have to sell it to 275. Oof. That means I'm losing $20, which is $2,000. I mean, you can offset the premium, so it's really only like $1,300. But, it could go down to $250. So there's basically a limitless loss potential.
Right.
We don't like that, right? I mean, having that kind of... obviously, you can exit out early if you need to, But still, that's kind of not that nice.
Yeah.
Not that great. So what we can do with credit spreads is we can limit the loss by buying a further out-of-the-money option. All right, so this is called a put-credit spread or a bull-put spread. It's called a bull-put spread because it's neutral to bullish, because remember, when you sell a put, you think the stock will not go down. All right?
That's right.
So if I'm selling the $2.95, and let's just say I buy the $2.85, right? So you can sell the $2.95 put and buy the $2.85 put. Mm-hmm. It's just like the debit spread, just reversed.
Yeah.
So let's say I buy the $2.85, which is $4.13. Now what that means is I receive a credit of $6.59 for the $2.95. I spend, how much did I just say that was?
What? Oh.
$4.13 I spend on the $2.85 put. So you subtract those two, just like the other one. So $6.53 minus $4.13 is $2.40. So for that kind of credit spread, I would receive a credit of $2.40 or $240 times 100.
Right.
So not as nice as the $6.53, but
why did it go down? Because what did you do?
Okay, so I know it's a lot. So I'm selling the $2.95 for $653.
Yep.
But I'm buying, to limit my loss, I'm buying the $2.85 for $413.
Oh, and that's another data number? What?
Right, so you
have to look
subtract
up
those two.
Yeah. No, I didn't know you got $413.
Oh, $413 was the price of the $2.85.
Oh, okay. So you had to look it up.
Yep.
Okay.
So I still receive a credit, but I'm only receiving $240 instead of $653. Yeah. But let's say that SPY falls down to $275 again. The most I can lose is $1,000 instead of $2,000. Mm-hmm. Which still stinks, but that's my max loss. But then you have to subtract the $240. So really I can lose up to $760. Mm-hmm. Right, $1,000 minus the $240 that I receive as a credit, I can't lose any more than $760.
Right.
So with credit spreads, the benefit of those is that it just limits your max loss.
Okay.
Yes, it reduces your credit, but it reduces the max loss. And another thing it does is that it limits the margin requirement. Now, this is hard to explain, so I won't spend too much time on it. But when you just sell a put or you just sell a call, that's called a naked option. Because, you don't have anything offsetting that. Like, you're just selling a put.
And just one.
But you have limitless downside.
Yeah.
And so because of that, the broker kind of says, now wait a second, this is risky. So you have to put up a lot of margin for that trade, right? So for something like that, and I don't know the exact number, but it would probably be a few $1,000s margin. That just means it's collateral, or I have to put aside a certain amount of cash so that if things go wrong, the broker knows that I can cover it.
Yeah. Okay.
With something like that, with that high of a naked put, it's usually a few $1,000s. Oof. But if I limit the downside by buying an option, then my margin requirement goes down to my max loss, which is $760 in this case. So instead of having to put out a few $1,000s to set aside, I only have to put aside $760.
Right.
That way, if I lose it, that's all I can ever lose. That's it. Right.
So it's safer.
It's safer. It's, again, more capital efficient, which means you have to set aside less collateral to trade that option. Collateral, when you set aside cash, it just means It doesn't go anywhere. It just means you can't use it to trade other things.
Oh, okay.
So that $760 doesn't go anywhere. It just means it's kind of locked away, so I can't use it for something else.
Right.
Right? So the benefits of a credit spread is that, number one, again, it limits your maximum loss. Number two, it reduces the margin requirement, which just means, how much money you have to set aside as collateral for that option. And the downside is that it lowers your credit that you receive. Remember, the credit you receive is the maximum money you can get from that trade. So This trade, I couldn't make any more than $240, but I can't lose any more than $760. So it's not that bad. Now, if I didn't even want to lose that much, I could instead buy the $290. I would receive less credit. I won't even look up what that is just because it gets too confusing. But I would receive less credit, but then I could only lose up to $500 minus whatever the premium was. So it's always, for me, I like to keep things small. So my credit spreads are usually like $2 wide. Because then I can't lose any more than $200.
Right.
Minus my premium. It depends on your portfolio size, right? If you have a really large portfolio, you might have $5 or $10 spreads or even more. I like to keep it small.
Well, you have a smaller one.
Yeah, I have a smaller portfolio right now, so that's the benefit of credit spreads. Again, it's not as fun as, getting a huge credit up front.
Yeah.
But the advantages are, numerous
But it's smarter, I feel like.
You're getting less credit, but you can lose less. You can't lose so much.
Yeah, I think it's smarter.
Yeah. So spreads, I love spreads. I mean, a lot of people do naked options. There's something called a naked strangle. It sounds so bad. I'm sorry. That really sounds... there's something called a naked strangle, which means I sell a put and I sell a call, both naked. Oh. So let's say, SPY is where it is. I could sell a $295 put and maybe sell a $310 call. And as long as SPY trades in between those two, I make... I make the premium, the credit.
Do you ever do that?
No, that's super risky.
Yeah, sounds like it.
Because you have downside on both ends.
Because you're not buying one and selling the other.
Right, you're selling both.
Right.
Which is a huge credit.
Yeah, that sounds like it.
But it has to stay in that range. So the safer version of a naked strangle is what we call an iron condor. So an iron condor, and this is a little more advanced, and I won't get into it today, I'm just going to describe it briefly. It's basically when you combine a put credit spread, which is what we just talked about, and a call credit spread.
Oh, okay.
So let's say, for example, I sell the $295 put and buy the $290 put. That's a put credit spread. Mm-hmm. And then let's say, for example, I sell the $310 call and buy the $315 call. That's a call credit spread. If it stays in between those two numbers, $295 to $310, I keep all the credit. But if it goes out of my range, my maximum loss is still just $5. Because each one is $5 wide, you see, minus whatever credit I got. So, that's... Iron condors are really nice because they give you more of a credit. You get to keep more of a credit. And it's still only a maximum loss. It kind of reduces your maximum loss. Okay? So I really like iron condors. It just depends. But they're kind of, like I said, the limited version. We call this, so spreads like this we call defined risk. Because when you just sell a naked option, it's called undefined risk because there's no maximum loss. It's limitless, pretty much. And so we call it defined risk when you make it a spread. And
because you can control how much the risk.
Right. You can control, I don't want to lose more than this amount. And as I said Wednesday, you have to build that in where you have to be willing to lose the most. So you might say, oh, I'll get this much of a credit if I make it $2 wide, but I'll get double the credit if I make it $5 wide. So I'll make it $5 wide. But if you're not willing to lose $500, don't do that.
Yeah.
Do you know what I mean? So you have to look at, what am I willing to lose on this trade?
Like the highest.
Right. What's the most I'm willing to lose? And then build a strategy around that. Right. So that's sort of how that works. So that's where I'm going to stop. Iron condors, I kind of touched on briefly. I think maybe we'll have a day where we do like advanced option spreads, because there's iron condors, there's iron butterflies, there's naked strangles, naked straddles.
Oh, wow. That sounds really bad.
That does sound really bad.
Naked straddle.
I know. That sounds horrible.
And then they should have naked horse. I'm just saying, they sound a little...
I know. They're really bad. But anyway, there's lots of other strategies that are more advanced. There are calendar spreads. There are, diagonals.
Oh, my God.
All sorts of
Sounds
spreads.
Sounds like bingo. Diagonals.
So, these are the basic two strategies. The put credit spread, where you're selling a put and buying a lower put. You still receive a credit. And the call credit, where you're selling a call that's out of the money and buying a higher call that's even more out of the money, you still receive a credit. If you combine those two, it's an iron condor, but there's more to that I'll cover another day. And so quick review with debit spreads. The advantage is number 1, lower break even. Number 2, less cash requirement, lower cash requirement. And number 3, you could say, more likely to profit because of the lower break even. It's going to be easier to reach it. Mm-hmm. The downside is that it caps your profit. With credit spreads, the advantages are, number 1, that it limits your downside, your maximum loss. Number 2, it's a lower margin requirement or lower collateral. But the downside is that, it's you're not going to receive as much credit. And the credit receiver, the credit spread or a short option, that's your maximum profit. You can't get more than you receive on day 1 when you're selling options, right? So that's a lot. I know. Hopefully that makes sense. Christine was able to keep up most of the time, so that was cool.
My brain is now mush, though.
I'm sorry. Is that what I see coming out of your ears?
Yes, okay. Probably.
So yeah, that's how that works. Basically, we'll extend that another day, not for a while, because Christine's brain needs to reset.
Thanks.
And so no, but we'll do an advanced options strategies day another day.
We'll get people to get used to this first.
Yeah, so those are how debit spreads and credit spreads work. If you have comments or questions, feel free to ask. You can look at the show notes at possiblepromise.com/7. And
just don't ask me.
I think you should ask Christine.
No.
And if you want to ask a question for next Wednesday's Ask Possible Promise, you can go to possiblepromise.com/ask. And also, again, we're on iTunes, we're on Spotify, we're on tons of other places. Not Stitcher.
For sure you checked?
No, I haven't checked, but it's just going to be an ongoing thing. Oh. It reminds me of on Tasty Trade. They've been asking Tom, who's one of the main guys in Tasty Trade, to look for his stamp collection for like a week now. Every day, I'm going to look for my... Because they don't believe in me as a stamp collection.
Oh my God.
And they keep saying, come on, look for your stamp collection and show us. And he's, look for it tonight. And then the next day, I was too busy last night. So it's like an ongoing thing at this point. It's been like, I don't even know, a week or so now. So this is our equivalent. Not really, but we're not on Stitcher. I don't know if we are. It doesn't matter. I don't even use Stitcher. I'm going to look.
You should check.
I will check.
Monday will tell you.
Monday, yeah, maybe. So that's our show today. I hope that you enjoyed it, and we'll be back on Monday for another episode. I have no idea what we're going to talk about yet Monday, but we'll talk about something, I'm sure. And so we'll be back Monday for another episode of the Possible Promise podcast. Thanks, everyone, for listening. Have a wonderful weekend.
Have a wonderful, wacky weekend.
Bye.
Bye.